Most people believe leverage is the primary risk in housing. It isn't. Leverage magnifies outcomes, but duration determines sensitivity, and duration is the quiet force that can erode wealth even when prices appear stable. You can survive leverage in a stable rate regime. You cannot ignore duration in a shifting one. In the next few minutes, you'll see why long-duration assets are uniquely vulnerable to rate changes, how duration and leverage interact inside balance sheets, where hidden exposure accumulates, and how a rational individual reduces fragility inside long-cycle assets like housing. Duration measures how sensitive an asset's value is to changes in interest rates. The longer the duration, the more the price moves when rates change. A 30-year mortgage is by definition a long-duration instrument. When you finance property over 3 decades, you embed long-term rate sensitivity into your personal balance sheet. When rates fall, long-duration assets rise sharply in value because future cash flows are discounted at lower rates. When rates rise, those same assets decline disproportionately. This is why housing booms often coincide with falling rate environments, and it is why tightening cycles feel more severe than the size of the rate move suggests. Here is the structural insight. Duration amplifies policy shifts. When central banks hold rates low for extended periods, asset prices inflate because discount rates remain suppressed. Valuations expand, not necessarily because productivity improved, but because capital became cheaper. But when policy reverses, the repricing is not gradual, it is mathematical. Even if housing supply remains constrained, even if demographic demand persists, even if employment is stable, duration sensitivity can override those forces in the short to medium term. Discounting arithmetic does not negotiate with narratives. Now layer leverage onto duration. If you purchase property with a high loan-to-value ratio, you are not only exposed to price fluctuations, you are exposed to equity compression. A 10% decline in property value may translate into a much larger percentage decline in your equity position when leverage is elevated. That is the interaction. Duration magnifies valuation shifts. Leverage magnifies equity impact. Together, they create balance sheet sensitivity. Many households underestimate duration risk because housing feels slow. Prices do not update in real time like equities. There are no daily quotes flashing on a screen. But sensitivity exists whether it is visible or not. If refinancing channels close in higher rate environments, mobility declines. If transaction volume falls, price discovery slows, liquidity tightens. Stagnation replaces momentum. Stagnation is not dramatic, it is quiet. But if inflation persists while nominal housing prices remain flat, real purchasing power erodes. Duration risk can reduce wealth not only through sharp corrections, but through prolonged periods of underperformance relative to inflation. This is why resilience must be built into exposure. Resilience in a long-duration system means avoiding dependence on perpetual refinancing assumptions. It means respecting loan-to-value ratios. It means recognizing that a low fixed rate is not simply cheap financing, it is insulation against future rate volatility. It means understanding that appreciation trends built during falling rate decades may not repeat during neutral or rising rate regimes. Housing is not fragile because it is tangible, it is sensitive because it is discounted, and discounted assets respond to rate regimes. Durable wealth is not built by assuming policy will indefinitely suppress duration risk. It is built by structuring exposure so that rate cycles do not threaten solvency, liquidity, or flexibility. It is built by understanding that balance sheets must survive both tightening and easing environments. Duration is quiet. It does not announce itself in headlines, but it shapes valuation, refinancing optionality, and equity resilience across decades. And in long-cycle assets financed with leverage, the silent variable is often the decisive one. Thank you for watching Genesis of Success. If you found this video helpful, please subscribe, like, and leave a comment. We read all comments, and if there's a topic or question you want covered, let us know, and we'll create a video to help.